What unusual assets are hidden inflation hedges? Imagine trying to protect your money from rising prices, but not just with the usual gold or real estate. Sometimes, the best tools are the ones you might not expect. Today, we're uncovering some of these less obvious assets that can help shield your wealth during inflation periods. One interesting option is floating rate loans. These are loans where the interest rate adjusts periodically based on a short-term benchmark interest rate plus a fixed margin. When inflation pushes rates higher, the interest payments on these loans also increase, helping you stay ahead of rising prices. But keep in mind, these loans are often issued by companies with lower credit ratings, so they carry a bit more risk. They tend to perform well when inflation is high and the economy is growing, but can suffer if growth slows down even with inflation. Next, consider private real assets and infrastructure investments. These are investments in things like private roads, bridges, or natural resources that aren't traded on public markets. Many of these assets have contracts or revenue streams that are linked to inflation or escalate with rising costs. Because of this, they can provide steady returns even when prices are climbing. They often outperform public assets during inflation because they are less affected by market swings and have more predictable income streams. Another option is commodity-focused exchange-traded funds and mutual funds. These funds invest in natural resources, energy, and agricultural products. When inflation occurs, commodity prices tend to go up because the cost of raw materials and energy increases. And like gold, which can sometimes be unpredictable after the 1980s, diversified commodity investments have historically kept pace with or outpaced inflation during inflationary times. Certain stocks can also act as inflation hedges. Companies in sectors like technology and healthcare often have less sensitivity to rising input costs because they rely on innovation and services. Firms with strong pricing power and a history of paying dividends can help investors keep their purchasing power intact, even when prices are rising. And of course, there are Treasury Inflation-Protected Securities. These are government bonds where the principal and interest payments are adjusted according to the consumer price index. While they are a direct way to hedge against inflation, rising interest rates that often come with inflation can reduce their market value. So, they might not always give the best returns if rates climb sharply. Understanding these assets is important when reading inflation reports and measuring economic price changes. They can help diversify your portfolio and reduce risk during inflation spikes. When inflation data shows prices are rising, adding some of these assets can help you preserve your money's value. Conversely, if inflation seems to be stabilizing or falling, traditional fixed-income assets might become more attractive again. In the end, no single asset can fully protect you from inflation. Combining these unusual assets with traditional investments creates a more balanced approach. Keep an eye on inflation reports, watch how different assets respond, and adjust your investments accordingly. This way, you can better safeguard your wealth against the unpredictable tides of rising prices.